This is why you should check your IRA now. My name is Daniel. Last year I helped 24 clients avoid IRAs. Here's why. At the time of this recording, the S&P 500 is down over 7% in the last month. In the last month, I moved apartments, I got married, I went on a honeymoon, all while this is happening, and I had one client contact me. Not concerned about losing money or panicking, which most financial advisors are dealing with currently, but to affirm how for the first time ever, the markets are crashing and he doesn't have an ounce of worry. If you had $1 million in an IRA a month ago in the S&P 500, you lost over $74,000. That could be more than a year of work for some of you. So number one, check your IRA. And number two, here is how to continue growing your money but never have to worry about losing due to market downturns, and frankly, never having to worry about going back to work again or having history repeat itself like 2000, 2008, 2022 all over again. There's two main options we're going to go over in this video. First are direct rollover options. This is a one-to-one rollover from where it currently is in the IRA into a different strategy. Now, most people understand that employers have 401ks, IRAs. They also understand that there's different types of employment, like a school teacher or someone in the military who generally is going to get a pension. But what people don't understand is that if you are not in the role of, for example, a teacher or a person in the military, you can still get the same types of retirement as them, but instead you would just have to buy these things yourself. So on top of pensions, or some people will call that retirement pay, other employers are offering cash value life insurance policies, banks offer CDs, annuities, stock matches. Almost all of these you can do yourself. And what we're gonna be focusing on specifically is how you can essentially buy your own pension, but with a lot of other benefits. That is called a fixed indexed annuity with a guaranteed lifetime withdrawal benefit. Now, these are a type of annuity with an insurance company. First, I want to go over how traditional annuities work, and then how the modern ones are much different and more advantageous to you, the clients. That's being proven by annuity sales are up over 100% in the last 3 years. These are skyrocketing, and here's why. So first, traditional annuities. Some people are not the biggest fan of the traditional style, and understandably so. And that is because when someone has money in a 401k or an IRA, generally they're going to give that money to the insurance company, so your money goes to them, and the insurance company, then you are entering a contract or a deal for the insurance company to pay you an income. So just like a retired pay or a pension, you are giving money to the insurance company instead of with the pension company, and they are going to pay you an income. Now, there's a couple different problems with these traditional types of annuities, and that is that you are annuitizing the annuity, which means you are kind of entering that contract. So the first scenario is, let's say you had $1 million. Okay, the first year you are getting $60,000 of income. They guarantee you that into perpetuity as long as you live. Now, if you get that the first year, you get that the second year, let's say they're doing it monthly, so they're paying you $5,000 a month. Well, after the second month in the third year, you pass away. Well, you took 60 plus 60 plus 10 is $130,000 of retirement income. The insurance company guaranteed you that. Now, if you subtract $130,000 from the $1 million that you started with, you end up with $870,000 left. That means throughout your career, you saved an additional $870,000. If you were earning a $70,000 a year salary, that's over 11 years of work, and presumably you weren't saving your entire salary, so maybe more like 30 years of work that you saved up, and that money, do you think is going to go and pass to your heirs? Actually, in this case, it's not. You entered into that agreement with the insurance company. They are keeping that entire $870,000 and any of the interest that they gained using that money while you were taking income from it. A lot of people don't like this. They like the guaranteed income. They like that peace of mind. However, they don't really want to get in this situation where they give money to the insurance company, they pass away early, and, well, their spouse doesn't get the money. Or maybe they are doing a joint annuity and both them and their spouse pass away, and the money doesn't transfer to their heirs. Not a great situation to be in. You can understand why people don't like that. Second, if this is something you're okay with, is that, let's say again, you had $1 million, year one you took 60, year two you took 60, and 2 months in, so you've taken $130,000, something comes up, you need an emergency lump sum. Maybe it's an emergency, maybe it's an opportunity. If you wanted to access that money, well, you've taken $130,000, same thing as the last, from $1 million, you're left with $870,000. You actually cannot access this money. You can't even access it with a penalty. So you can't say, hey, I'm willing to take a 10% penalty. I'd like to access that money. Doesn't matter. You annuitize the annuity. You enter it into the contract. From there on, they are paying you the $60,000 until you pass away. You have no way of accessing that money or surrendering or even paying a penalty to get access to it. And again, this isn't something that people are really willing to do. Now that's the traditional annuity. Now let's get into the fixed indexed annuity with what is called the guaranteed lifetime withdrawal benefits rider. Sometimes it has a different name with different companies, but here's how it works. So your money is going to the insurance company. Same deal. Now that money inside of the insurance company, it's still yours. So if you wanted to pull it out, you could still do that. You could surrender the policy. You can access some of that money without any penalties. But first, that money is still growing. It's not like you put it in there, it's done. It doesn't really matter what the markets do anymore or what interest rates turn to. That money's locked up. It's not like that. That's how more traditional annuities are. But in this case, the money's still growing. You are getting credited interest. That interest is buying options, and you get credited a gain based on that. We'll touch on that a little bit more later in the video. It's not too important, but essentially your money's still growing and there's no risk due to market downturns 2 years. You don't have to worry about, well, if you said it grows when the market goes up, I don't really want to be in this. The whole reason I got into something like an annuity was to not deal with market volatility. You're correct, you're still not dealing with market volatility. So there's no risk and the money's still growing. Now, from there, with the guaranteed lifetime withdrawal benefits, that's what GLB stands for, the insurance company is paying you an income. You might say this sounds a lot like the traditional annuity, and so far it does, but there's a couple differences. So the money still grows, as we went over. Second is that the money passes to heirs if you pass away early. This is because you are not actually annuitizing the annuity. Instead, this rider allows you to start taking the income. So let's say it's the $1 million, you took the $60,000, you took the $60,000, third year, 2 months in, you've taken 10, that's $130,000 total. You have $870,000 left. Fortunately, you pass away, something unexpected happens. That $870,000 is going to transfer to your beneficiary. So whether that's your wife, whether that's your children, whether that's whoever, that money isn't going to disappear. That 11 plus years of salary, if it was a $70,000 salary, is not disappearing overnight just because you passed away early. And second, that second problem we talked about is you can still access this money in case of an emergency or in case of an opportunity. Now it's going to depend company to company, product to product, but generally you're going to be able to access up to around 10% completely penalty free. That's even if you've already started taking the income. Of course, if you took some of it, that guaranteed income amount is going to decrease. But even if you have not started taking the income, you could still access this money. And if you needed to access more than that 10%, for example, you could do that. Generally, there are going to be some penalties depending on how early you do that. Usually there's a surrender window. So if you tried to pull it out in the first year, maybe it is a 10% penalty, but maybe if you try to pull it out 7 years in, it might be something like a 2 or 3%. Just depends on what your surrender window is. And if you're beyond that, let's say it was a 7-year surrender window and you wanted to pull it out in year 8, there wouldn't be any penalty at all. But these are just the direct rollover options. And if it's not something that you're wanting to take income right away with, you actually don't have to. You can do that if you want to, but you can also delay income. You can also kind of leave the door open where you might want to turn this into guaranteed income later. You might not. You might just want to continue to let it grow. You can still do that. And if you're delaying this into the future and you know you're going to want to use this as income in retirement, for example, like people who are putting money into a pension, they know for sure that they're going to turn that on when they retire. With these, there's a lot of benefit into moving that money early and delaying it, let's say 10 years. Currently, I know of one company that does a 30% bonus on the amount that you put in. So if you put in $1 million, they give you 1.3 million. Then they guarantee that money is going to grow at a minimum, unless the indexes outperform it, at 8% a year, simple interest for 10 years. And after that 10-year period, then you can start taking income from that number. You start taking a percentage of that. So maybe it's 5-6%, which of course is much higher than the 4% withdrawal rate that most financial advisors recommend. And that is all completely guaranteed, and you know that money's there for sure. The whole reason, the whole philosophy behind doing something like this is not to take big risks or take a big gamble and try to hit home runs in the stock market. Instead, it is sorting your finances, having your money squared away for sure, so you can focus on the things that matter most to you. Your kids, your family, your faith, Whatever that is, you are at peace with your finances. You have those guarantees. You're not necessarily concerned with trying to earn the highest rate of return, optimize for your dollar, but instead optimize for your life. The second option are not direct rollovers, but they're rolling the money out and in to another strategy. This is going to be a pretty quick and basic explanation, but you would be using what is called maximum funded or overfunded indexed universal life insurance, so another product with insurance companies here. You're going to do this for a couple reasons if this is a strategy that you want to go with, which generally is a little bit more advantageous, but there's a couple more hoops or a couple more things to understand to jump through. So first is the tax codes are the reasons that you would do this. Big banks do this themselves, so they put a big portion of their liquid cash into cash value life insurance. It's called bank-owned life insurance. Big entrepreneurs, for example, Walt Disney, the Rockefellers, Ray Kroc, the founder of McDonald's, J.C. Penney, Hillary Clinton, a lot of politicians are doing this. You can speculate Donald Trump is doing these sorts of things, and everyday people are doing that. And that is because the money inside of a cash value life insurance policy, since it is considered insurance, is actually able to grow tax deferred, and then you can access that money income tax free. That's right, income tax free. And when you pass away, because it is life insurance, this money transfers income tax free under tax code 101A. The next big thing is that just with the fixed index annuity, and we'll get into this a little more detail here, is the money is still growing. So that is through what is called indexing. Essentially, you are giving money to the insurance company, you're funding the insurance policy. The most amount possible is going towards the cash value. The least amount possible is going towards the death benefit. All of the amounts that went towards the cash value gets credited interest. They use that interest to buy options, and then they credit you a gain. How it works very simply, without kind of going into great detail, is you had $1 million. Let's say that you were putting that in the S&P 500. That's not what's happening, but it's kind of like what's happening, is you're putting your money in the S&P 500, but there is what is called a cap, which is the maximum you can earn, and a floor, which is the minimum you can earn. So the floor is usually 0%, and let's say the cap is 10%. Well, if that's the case and the S&P 500 goes above 10% in a single year, so let's say the S&P 500 goes up 12%. Well, you hit your cap. You only gain 10%. Unfortunately, you miss out on that 2%, that extra little spread. Now, the upside to this is that when the S&P 500 goes down 10, 20, 40, 60%, you don't lose a dime because of that. So you have your floor of 0. So if the market goes down, the minimum amount that you can earn or get credited is 0%, so you don't have to worry about losing because of that. This is big in terms of peace of mind. So here's an example. If the market did 15%, well, you would get 10 because your cap is 10. If the market lost 20, you would get 0. So this means if we had $1 million, you have 1.1 million here, you locked in those gains and you reset. So even though the market went down 20% the next year, did you lose? No, you didn't lose a dime because of that. The next year, the market goes up 5%. So since this is in between your floor and your cap, you're going to equal whatever the S&P 500 did, in this case, 5%. That would mean you have 1.155 thousand there. And year 4, if the market goes down, I just put 3% there. Of course, you hit your floor, so you're not going to lose any money due to that. This is all happening income tax free as described before. Again, the big thing behind all of this, the reason you should do any of these strategies is simply because of the philosophy behind it. The fact that you would rather have peace of mind, would rather have time to focus on your friends, your family, your faith, rather than stress about finances, worry if you're going to have to go back to work and spend your retirement, staying up at night, grind your absolute best to optimize your dollar so that you can make the biggest possible gain you could possibly have. That's all going to go away inevitably when you die. If you'd like to learn about this in much greater detail, subscribe or release videos 3 times a week and also do a live stream. I will see you there.